Hi, everybody, and welcome back to video number 7, our last video in Chapter 8. And when we left off, we were looking at the Hakeman clothing store and how they apply conventional retail method, inventory method. And so you may remember, if we go back, you may remember, here's the numbers that we had from the previous slide. Here's our costs and our retails. And so that's what they've done here. They put in the inventories at cost, $52,460. And then they've applied the beginning inventory, net purchases at retail. They would add in the additional markups, subtotal of 122,000, back out net markdowns, and sales revenue, 95,000. And that leaves me with my ending inventory at retail of 25,000. So now, if I establish the cost to retail percentage here, I'm going to take a look at this 52,460 and divide it by 122,000. That'll give me 43%. And now I take this same 25,000 multiplied by 43%, and that gives me my inventory at cost under conventional retail of $10,750. Okay, now if we convert to LIFO retail inventory, Hakeman Clothing can then quickly approximate the ending inventory for 2025 under the LIFO retail method here. So how would we do that? We take the December 31, 2025 inventory at LIFO cost. So we would take retail divided by 25,000 and our ratio, and that's going to give us LIFO divided by 11,250. So how would we do that? We compute that by taking the net, need to compute this 45%. We're going to take the net purchase at cost, 47,250 here, and we'll divide that by the net purchase at retail plus markups less markdowns. So we have the 100,000 plus the 7,000 minus the 2,000. We get that here. And that gives us 45%. So 25,000 times 45% gives us 11,250 LIFO. All right, now we'll take a look at comparing GAAP to IFRS and how we value inventories under those two systems. Okay, similarities. IFRS and GAAP account for inventory acquisitions at historical cost and evaluate inventory for lower of cost or net realizable value subsequent to acquisition. Who owns the goods? Goods in transit, consigned goods, special sales agreements, as well as the cost to include in inventory are essentially the same as accounted for under IFRS and GAAP. Okay, differences, quite a few here. The requirements for accounting for and reporting inventories are more principles-based under IFRS. That is, GAAP provides more detailed guidelines in inventory accounting. I have an exam question for that later, but I think you get the idea. A major difference between IFRS and GAAP relates to the LIFO cost flow assumption. GAAP permits the use of LIFO for inventory valuation. IFRS does not. It prohibits its use. So FIFO and average cost are the only two acceptable cost flow assumptions permitted under IFRS. When I first started in accounting, I thought that was short-sighted of IFRS. But now that I know how you can manipulate LIFO, way beyond the course, way beyond the concept of this course, but I agree now that LIFO should probably not should not be permitted under GAAP as well. But they didn't ask me, so currently it is permitted. Both sets of standards permit specific identification where appropriate. Now, the IFRS does not have an exception to the lower of cost or net realizable value rule for LIFO/retail inventory methods. IFRS does not allow LIFO, of course. So GAAP, on the other hand, for LIFO/retail inventory method companies, defines market as the replacement cost subject to the constraints of net realizable value, the ceiling, and net realizable value less a normal markup, the floor. IFRS does not use a ceiling or a floor to determine the lower of cost or market. More differences. Under GAAP, if inventory is written down under lower of cost or net realizable value or lower of cost or market valuation, the new basis is now considered its costs. As a result, the inventory may not be written back up to its original cost in a subsequent period. Under IFRS, the write-down may be reversed in a subsequent period up to the amount of the previous write-down. Both the write-down and any subsequent reversal should be reported on the income statement. So the IFRS also requires biological assets and agricultural produce at the point of harvest to be reported at net realizable value. GAAP does not require companies to account for all biological assets in the same way. So furthermore, these assets generally are not reported at net realizable value. Disclosure requirements also differ between the two sets of standards. Okay, that ends Chapter 8. And when we return, we will continue with Chapter 9. Until that time, bye for now.